Hi, welcome to my morning video for the NFPs. I'm just going to give you the structure or layout of this video to start off. I'm going to start off by looking at the background to the up and coming NFPs, as well as demonstration of what could happen based on previous events. We're going to look at the last NFP release and see how the release affected the markets. This to give us a good idea of what could happen next time, which was lead us on to kind of predictions on what could happen this time, and then we're looking at how this could affect open positions and how to hedge. So let's start with the background, and I've got it up here on my screen. This is the expectations and the previous results. So expectations are for a rise in payrolls of 180,000. This prediction is less than the average growth for 2015, which is 198,000. So we're expecting a less than average growth rate. So it's slightly lower than usual, this 100k figure, but it's up from last month's release, which was 142,000. So we're expecting more than last month, but last month was a bit of a shock to people watching the NFPs. It was poor data, but yeah, we'll get onto that now. Yeah, so last NFPs they had the expectations of 203,000. However, we only got 142,000. Okay, here this 1,000. And what this had, it led to a very interesting effect on the markets. And now to see that, we're gonna take a look at the S&P 500. So yeah, this was the S&P 500 just before the release. This is the 10th of the 2nd, and for most of the day we were flat. This is an hourly chart, by the way, S&P 500. So most of the day we were pretty flat, going in, and then boom, the NFPs were released. Big sell-off. As stated before, they were much worse than expected at 142,000 compared to 203,000, which was the expected figure. So we had a big sell-off. But look what happened after. Bang, came back very strongly as well. I mean, this made the bullish engulfing, and we never really looked back. Like, it sparked a huge rally. It's a good trade. Apologies for that. So yeah, what's caused this kind of like schizophrenic flip-flop movements down and then up? And we had a double bottom here as well. So it's good price action. If you like trading price action, this would be nice. But yeah, what's caused the sell-off? Well, for the sell-off, it's quite straightforward, really. It's poor data. I mean, poor unemployment means a weaker economy, really. I mean, for logical reasons, there's less people with a job. That means people have less money. Well, it's not the fact that there's less people with a job. There's just less than expected. Thus, the economy is weaker than would have been expected. So, yeah, it was poor. But then, if the economy is weak and the figure's telling us it's weak, why did we come back? Well, this is a good question, and we can answer that by taking a look at what happened to the probability of a rate hike, i.e., how did this event affect interest rate expectations? So I'm going to pop up a chart of that. So yeah, this is a chart of the Fed probability contracts. The orange line is the open interest, so this is how many people are trading on the Fed futures contracts, which are hedge funds, banks, and traders of sorts use to hedge interest rate exposure. And this is the contract price, this blue one, which is how much a contract is worth. The orange line relates to this x-axis, and the blue line relates to this x-axis. So to start off with the contract price, what we saw, this is the day of the release on the Friday, and this is the Monday. Okay, so 2nd was the Friday, the 5th was the Monday. So the contract price, as you can see, we're here at 99.835, and we rose to Monday at 99.85. Now what this is telling you is that the probability of rate hike is falling. This because the closer to 100 this gets, this means the less likely there is to hike. So at here, there's a higher probability that people are pricing in that there's going to be a hike. So yeah, and that rose up to here. So people are less likely thinking they're going to be a hike. And this is supported by open interest, which jumped hugely. This means that there's real investor sentiment. This isn't just a few kind of big traders manipulating the market or anything. This is kind of showing you that there's a real change in emphasis. And what does this overall show you? Well, it shows you that that investors are seeing that there's going to be cheaper money for longer. So let's take a look back at the S&P 500. So back on the SPX 500 at 1 hour, and as you can see, the cheaper money effects, or the expectations for longer cheaper money, led to a rally, and this was this bull rally here. So what we had overall, bad data pushing it down, and then cheap money expectations pushing it back up, and we got a nice rally off that. So yeah, that kind of overview of what happened last time. So let's bring that on to what happened this time. What could, happen this time. So this is still the SPX 500 at 1 hour, and this is the current price of the level of today. It's just before 7 in the morning in London, Canary, and yeah. So let's demonstrate. We're going to demonstrate what could happen with an inverse case, i.e., if the data came out good or better than expected. Well, what we'd like to see is an inverse case. So I'm going to draw this on for you. So the good data could lead to a price rise, because obviously less unemployed people, the better it is for the economy. More money and everything, everyone's happy. So we could see a rise. Let's say we'll rise like this, up there. But once again, we have a Fed probability of a rate hike coming back into play, of real emphasis in the market at the moment. Now, good data means more people have more money. This means they could get spending, and yes, more money's chasing scarce resources, leads to inflation. And also, this is really compounded by the fact that December has recently come back on the cards after the last Fed meeting, where they said December is looking likely. I'm more of a January man myself, but you know, investors as they are, they like to play what they can. So yeah, so in short, the expectations, if good, could see the expectations for cheap money shorten, so they'll think that interest rates are going to rise sooner. So what could happen here? Well, we get an inverse. We get a sell back down, like this. So we could trot along here as the good data comes out, going up, going up, going up, and then we'll come back down, if you see what I mean. Now this is extreme volatility. So we're jumping up and then we're jumping down, all on the same data, you know. And the investors aren't taking it one way or another, they're taking it two ways. Yeah, so I mean, how do you play this, especially if you've got open positions? You know, how do you defend yourself? I myself have an open position, so I'm going to show you how I will be kind of protecting my position / trying to grab a few pips off this as well. So let me show you. So yeah, just quickly, if you didn't know how I traded, what I use is the correlation between equity markets, and my current trade is the S&P 500 and UK 100. And what I do is I play, when the two assets get to extreme differences, I try and play them back together. And I entered the current trade on the 30th of the 10th 2015. As you can see, we had a bit of a shaky week, but we're alright because the risk is quite well controlled on the account. It's one of the things that I aim to control the most. So we can pull back slightly, but we're just a bit worse off than when we started. To demonstrate how this works on the charts, I'll show you. So here's the UK 100. It's the FTSE, or the daily. It's on the daily chart. As you can see, what these are Bollinger Bands. Now, this is a 75 simple standard mean. which takes the price for the last 75 bars and calculates that average. And then this is 1 Bollinger Band away. This is a measure of volatility. It's mathematically a standard deviation, but you use them to assess relative pricing for assets. So as you can see, we're quite close to our 75 mean. Now if I bring up a chart of the SPX 500 here, what you can see is, this is a daily, what you can see here is we're above 1 Bollinger Band, whereas the FTSE's down here at 75 mean. This is above 1, it's almost at 2, it's pretty much spot in the middle. But yeah, we're trying to play them back together to like here. So if I bring up the UK 100 again, back together like here. Now the NFPs pose a threat because they could affect the S&P 500 more so than the UK 100. So if I bring that back up, the question is, what happens if they come out good and they boom up here? We do get a sell-off after, but initially we're heavily exposed to this event. We can go up here, and this has really hit the account, and volatility is not great on an account, especially on a longer term portfolio. It looks a bit bad, get bagged, draw down and everything. So I'll show you what you do. Yeah, so this is the pound dollar chart, and it's 1 hour, and we're looking at the previous NFP release again. Yeah, this was the release for the 2nd of the 10th, and this is what happened to the pound dollar after. As you can see, pound sharply rose, got stronger. This is due to, let's just flick up the SPX 500. Sorry, that's the wrong one. It is this one. Here we go. As you can see, bad data meant that the economy is weaker, and we sold off, and then cheap money is going to last for longer, so we rallied. Now that just played out on the pound dollar very simply. It's much simpler because the bad data meant the dollar's weaker. So the dollar's weaker because the economy is weaker, so we got a rise, and then this was added to by the fact that cheap money weakens the dollar because lower interest rates. If you're a carry trader or you're searching for yield, the dollar's not going to look so attractive. So that simply just rose. So yeah, this is how you protect your position basically. What you do is, if in this circumstance I had been, let's go back on the SPX 500. I'd been short, let's just hypothetically say I'd been short of SPX 500. Now, sorry, I meant, let's just say I was hypothetically long the SPX 500. So I'm playing it up here. Maybe I brought it down here. So far it's been going down well. I mean, I made a decent run up. It was a good trade. But I'm a bit nervous. I just don't want the volatility of my account really. How do I stop myself getting hit hard by this pull down? Well, it's quite simple. You buy the pound. If we bring that back up, see, if you brought the pound here, this would have rallied. Whilst, sorry, one chart again. Whilst this would have sold off. So you sell off, rally, sell off, rally, and then as you can see, I mean, you would have defended that position. You wouldn't have had the same level of volatility in your account, and you probably would have grabbed a few pips off this, because as this rose, you could have taken this out maybe around here as the SPX 500 reversed. So it reversed and started to come up in your favour, and maybe this one would have pulled back against you a bit. So you could have taken this one out as this one. You could have taken the pound dollar trade out as this one started to turn around. Maybe you saw this on the this bullish engulfing on the hourly chart. You think, oh, that's nice, that could lead to a rally. And then you're looking at the pound dollar at the same time, 3 o'clock, you would have been here. So you've grabbed all these pips and you've defended the position. So not only have you defended yourself against volatility in your account, but you've also grabbed a few pips. As you can see, you may have hurt your account for a little bit. The pound dollar would have helped defend this, but Once it's got above here, you're back in profit and you're much up before. So yeah, this is what I'm gonna do for the most recent one. So if we just go on the daily and we flick it back to the most recent thing, but because I'm in the opposite way round, obviously. If you go back on this chart, as I said, this is a daily for the SPX 500. I'm short. So what this means is that if there was good data, then it would spike against us, and then come back. So what would happen on the pound? Well, very simply, the pound would strengthen against the dollar, and we would have a sell-off. This is because cheap money because the American economy is getting better because there's less unemployment, and then the probability of cheap money is becoming less, so the December rate hike looks more probable, and that's going to affect that by selling off. This is just going to sell off. So I'm going to short this pound dollar coming into the event. You're going to wait for a good price level and everything, and that means throughout the event I'm going to be defended against any good data from the non-farm payrolls. So that's simplistically how I'm going to play it. Yeah, I mean, it's quite a big event. I really would suggest you hedge it. Yeah, if you need any help with that, then you're more than free to copy me or anything as such, and that will help defend your open positions and so on and so forth. But hope everyone has a good NFPs and has found this video useful, and best of luck for the day and happy trading. Bye bye.